Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today, we're sharing 3 stories. First, we're digging into the record $7.6 trillion wall of cash in money market funds. Wall Street expects a rally, but data expert Peter Crane reveals why 60% of it is going nowhere. Second, we'll explore why a massive $2.3 billion scandal is causing China's super rich to flee Singapore, and how rival hub Hong Kong is poaching them, already boasting 2,700 family offices. And third, we're covering the $80 billion showdown between Eli Lilly and Novo Nordisk over new daily weight loss pills. Novo's look stronger, but Lilly's small molecule technology might be its secret weapon. Let's start with a single statistic that might just change your entire perspective on the market. There is a record-breaking $7.6 trillion sitting on the sidelines in money market funds. Now, for those who might not know, money market funds are a type of mutual fund investing in very short-term, high-quality debt. Think of it as a high-yield cash parking lot. They become incredibly popular because they offer much higher interest rates than traditional bank savings accounts, but with a similar level of safety. Wall Street is calling it a wall of cash, and the theory is simple. When the Federal Reserve starts cutting interest rates, that mountain of money is supposed to pour into the stock market, igniting a massive rally. The reasoning is that as yields on these safe funds fall, investors will be forced to look elsewhere for better returns, and stocks are the logical next step. It's a classic risk-on rotation, but that's not the whole picture. The real turning point, according to one top data expert, is a blunt message for that theory. His words: dream on Wall Street. Peter Crane of Crane Data, the firm tracking this cash, says the data tells a completely different story. In the entire 52-year history of money market funds, assets have only ever dropped twice: after the dot-com bust and the 2008 financial crisis, when interest rates were nailed to zero. He reveals that today, roughly 60% of that $7.6 trillion isn't from small investors, it's institutional and corporate cash. His take, quote, "They are not moving no matter what. They are not going into the stock market." Now, the core of the issue is this. This institutional cash isn't just sitting there waiting for a stock tip. We're talking about corporate treasuries that need cash for payroll, pension funds with strict liquidity rules, and insurance companies that must have funds ready to pay out claims. What's often overlooked is that many of these institutions are bound by regulations, like the SEC's Rule 207, that mandate they prioritize capital preservation and liquidity above all else. For them, a money market fund isn't an investment choice. It's an operational necessity. And even a small rate cut might not be the catalyst everyone expects. Think about it. While money markets are paying over 4%, the average bank deposit is paying maybe 0.5%. Interestingly enough, there's an estimated $20 trillion still sitting in those near zero yield bank accounts, mostly due to simple inertia and a preference for familiar local banks. So compared to that, money markets look like a fantastic deal. Even if Fed cuts bring yields down to 3%, that's still a massive gap. Crane's analysis suggests only about 10% of the cash is even in play. This is the retail investor money, and it's the exact slice of the pie that modern fintech apps are targeting with slick interfaces and behavioral nudges, trying to make it frictionless to move that cash into investments. This leads to his explosive prediction. As the market anticipates a flood of cash, Crane declares, quote, "The $7 trillion is not going anywhere but up." So this sets up the ultimate paradox for investors. The one thing that could force this cash to move rates plunging to zero would likely only happen in a severe economic downturn, a scenario where investors typically flee from risk, not embrace it. And if even a fraction of that cash does flow into the stock market, the way most people invest today through passive index funds like S&P 500 ETFs means that money would automatically flow into the biggest companies. This could accelerate the market's concentration into just a handful of mega cap tech stocks, potentially increasing systemic risk for everyone. The question becomes, what's the real trigger for this wall of cash? A booming market or a breaking one? Now, we just talked about a massive wall of institutional cash that's likely staying put, but a different kind of money. The personal fortunes of China's super rich is definitely on the move, and its destination has suddenly changed. Just a few years ago, Singapore was the ultimate safe haven for them. Now, they're leaving in droves. One lawyer who works with them says he's surprised, noting these wealthy Chinese have very short memories and have forgotten why they fled to Singapore in the first place. The trigger for this reversal was a colossal $2.3 billion money laundering scandal that sent shockwaves through the city-state. In response, Singapore slammed the brakes, launching an aggressive cleanup that has regulators and banks rescreening every wealthy client with a fine-tooth comb. So, what's happening behind the scenes of this cleanup? Singaporean banks are in a full-blown reg tech arms race. They are deploying advanced AI for identity verification, using facial biometrics, and running automated systems that monitor every single transaction in real time to spot suspicious activity instantly. This is where the situation takes a more complex turn because all this technology creates a ton of friction. Research shows that nearly 90% of banks in Singapore have already lost clients simply due to slow and inefficient onboarding, even before this new crackdown. For many legitimate clients, these tools feel less like a scalpel and more like a sledgehammer. The fallout was immediate. One director at a law firm reports applications from mainland clients have cratered by 50% since 2022. His blunt assessment, when the Fujian news broke, a lot of these wealthy Chinese left. So literally almost all they go to Hong Kong, the Middle East, Japan. The compliance checks have become so invasive that clients are walking away, with one lawyer describing their frustration, asking, do I really need to declare my illegitimate son just because I want to manage wealth in Singapore? And that question gets to the heart of a huge global debate. The situation presents a fascinating duality. On one side, a government's need to prevent crime, and on the other, an individual's right to privacy. These Know Your Customer regulations, or KYC, force banks to collect incredibly sensitive personal data, but this can directly conflict with data protection laws that say you should only collect the minimum information necessary. European courts have already started pushing back on making this kind of data public, so this isn't just a Singapore problem, it's a worldwide battle between transparency and privacy, and the ultra-wealthy are on the front lines. With some Know Your Customer approvals in Singapore now taking over a year, rival hubs are rolling out the red carpet, Dubai is processing applications in a matter of months, and it's not just about speed. Dubai is engineering a cultural vibe to attract this new generation of wealth, investing billions into world-class nightlife, entertainment, and luxury amenities. It recognizes that for today's high net worth individuals, lifestyle is just as important as financial incentives. Now, get this. In a stunning reversal, Hong Kong, the very place these families originally fled to escape Beijing's grip, is now actively luring them back with lower barriers and new tax incentives. The numbers are staggering. By the end of last year, Hong Kong already had over 2,700 single-family offices, blowing past Singapore's 1,400. They've done it by reintroducing a program that offers residency for a minimum investment and by creating new tax exemptions. But this aggressive strategy comes with a huge risk. By lowering the barriers that Singapore is desperately trying to raise, many are asking if Hong Kong is just setting itself up to become the next hub for a major dirty money scandal. One advisory firm projects that Singapore's net inflow of millionaires is set to be less than half of what was expected just a year ago. It's a massive correction for a booming hub, leaving one big question: is Singapore's reign as the top destination for Asia's ultra-wealthy already over? Speaking of intense competition between global players, an $80 billion showdown is brewing in the pharmaceutical world. The two titans of weight loss, Eli Lilly and Novo Nordisk, are preparing to take their rivalry to the next frontier, daily pills. Both companies are expected to launch oral obesity drugs in the US next year, a move that could revolutionize a market currently dominated by weekly shots. The significance here is how it taps into a powerful psychological space. For decades, the idea of a diet pill has been plagued by a dangerous, often shady reputation. But the arrival of these effective pharma-backed oral medications could completely change the cultural conversation, making medical weight loss feel as normal as taking a daily vitamin. After all, the familiar form of a pill could accelerate acceptance far more than injections ever could. But a recent late-stage trial delivered a result that shook up Wall Street. In it, Eli Lilly's pill produced less weight loss than analysts had expected. The numbers are stark. Lilly's pill, or orforglipron, produced about 12% weight loss. Novo Nordisk's oral drug has led to about 17%. The market reaction was immediate, with analysts slashing their 2032 sales estimates for Lilly's drug by an average of $4.5 billion. However, if you zoom out, you'll see another layer of strategy at play. Lilly's chief scientific officer, Dan Skavronsky, came out swinging, firing back with a direct quote: "We wouldn't have undertaken this head-to-head phase 3 randomized control trial unless we had a lot of confidence that orforglipron would fare well. Lilly's bet isn't just on power, it's on convenience and a huge technological advantage." You see their pill is a small molecule. You can think of this like building with simple, standardized chemical ingredients. The process is well understood, scalable, and cost-effective. Novo's pill, however, is a peptide, a much more complex biological structure that has to be grown using biotechnology. That process is more expensive, slower, and much harder to scale up, which could lead to the same kinds of supply shortages we've seen with the injections. So Lilly is betting they can win by simply making more of their drug available to more people. Crucially, it doesn't have the food and water restrictions that come with Novo's pill. This is the other critical part of Lilly's strategy, and it's all about human behavior. Research on medication adherence is crystal clear. Even if a pill is more effective in a lab, its real-world success depends on people actually taking it correctly. Novo's pill has strict rules, like when you can eat or drink around taking it, that add a daily cognitive load. Studies show the more complex a daily routine is, the more likely people are to mess it up or just quit. For example, one study on similar drugs found patients on a simple once-weekly schedule were 20% less likely to stop their treatment than those on a daily one. Lilly is betting that a simple, no-fuss daily pill will lead to better real-world results, even with a slightly lower headline number. Novo Nordisk response? Their chief scientific officer says simply, "The data speak for themselves. So you have the core conflict. One pill appears more effective, while the other is easier to take and potentially easier to make." While analysts see these oral drugs capturing 20% of the massive $80 billion GLP-1 market by 2030, the real question is which company will claim the lion's share. And believe it or not, these pills probably won't be cheaper. The research suggests companies will price them at a premium, charging more for the convenience of avoiding a needle. In the battle for the future of weight loss, what wins? Maximum efficacy or ultimate convenience?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.